We are live. What is up, everybody? Hope you're having a great day. Spencer Israel here with Ian Culley, head of FICC, that's fixed income, commodities, and currencies at All Star Charts. Mr. Culley, we matched today. What's going on with that, man?
White t-shirts. It's uniform today.
Yeah, is there a reason for this? Are we talking cotton? Is that why we're doing this, or no?
Well, I like the looks of the cotton chart.
Yeah, I know. Okay. Let's I see we got some people in the chat. Welcome to What the FICC, the show where we talk about fixed income, commodities, and currencies, and rip through charts with the man himself. So, Mr. Culley, let's get started with our FICC market recap here. Let's start with gold as we usually do. What are you seeing in the gold markets here?
Gold's pulling back today along with silver. Still dealing with all that overhead supply around 2089. Those former highs, all-time highs going back to 2020 and early 2022. That's the level. This is, again, logical level to see, price digest the recent rally. As price continues to digest its recent gains, I'm paying attention to the pivot lows from last month around 1980. Below there, things get messy. Now GLD, here we go, another chart of gold futures. As long as it's above those former highs from 2011, the path of least resistance remains higher. I think the upside target of 2,500 is likely later this year. But again, as long as it's above 1924. Now the GLD ETF is holding its breakout. It's still above 85. As long as it's above 85, I like it long. Target up around 240. And the miners, you know how much I like the gold mining stocks.
Oh yeah, we talked all half of last week's show on what was it, Friday or Wednesday? I forget which one was gold mining stocks.
Yeah, that's the thing. The market conditions have been challenging.
Yeah,
but these gold mining stocks are breaking out, holding those breakouts, and a number of them have actually reached our initial targets. Some are actually breaking above our initial target. So I just love the space right now. GDX pulled back, classic retest here of a shelf of former highs around 33, dug in, and is now resolving higher. Path of least resistance for GDX up around 42. Those are those pivot highs from last year. Now, again, I talk about relative strength. How much I love the mining stocks? Well, not only are they resolving higher on an absolute basis here, they're also outperforming the broader market. They're outperforming their alternatives. That's a great sign.
All right. Still bullish gold.
And we'll switch gears to crude oil. A lot of activity in crude oil. Still finding support at that 65 level, which is a shelf of former highs going back to 2019. As polarity zone became support in 2021 and early 2022, and it's still acting as support today. We talked about that long wick last week. Very impressive. Bears drove prices down towards that 65 level, and this long wick just shows that bulls stepped in, kicked prices higher, and now we're starting to see price continue in that upward direction. Kind of rolling over a little bit today, but still buoyant for sure. In the middle of this range, I think maybe, we head back towards 83. Now the USO ETF, the oil ETF, the level for USO, 58.50. Still holding above that level. If and when USO is below 58.50, then we're likely seeing crude oil back below 65 and energy as a whole probably coming under pressure. And here's a look at the XLE energy sector ETF. I really like this chart, and I brought it today because I wanted to show that you have a downside resolution of an upward sloping trend line. This isn't a signal unto itself. Now, I'm not ready to go out and start shorting energy stocks. However, on a decisive close of below 75.50, I think that path of least resistance is lower. Right now, I'm just noticing that there's a potential trend change here for energy stocks. And what's interesting is when you look at the lower pane, here we have the 5-day rate of change. Notice back in October of 2021, you had this test of this trend line, and you see this strong 5-day rate of change up near 10%. Right? That indicated that the bulls came in and they drove prices higher. We saw the same action in October of last year. But what we didn't see towards the end of last year and earlier this year was bulls continuing to support higher prices. Notice that yellow circle back in late 2021, another jump, another rise in the 5-day rate of change, positive rate of change. That was missing. That was missing earlier this year. And what happened? What do we see now? We see a downside resolution of this upward sloping trend channel. So energy's on the ropes. That 75.50 level is front and center for XLE. Now moving on to copper, it's messy. It's messy, but it's constructive. I like copper as long as it's above those pivot highs from September of last year around 378. Right? As long as it holds above those highs, it's messy, but I want to give copper, I want to give base and industrial metals the benefit of the doubt. Now, if and when it breaks back above the pivot highs from November of last year, around $4, I think it speaks to a lot of strength in this area, strength in the economy, and strength in base and industrial metals, and we could see a rally following that close. FCX, talked about FCX last week.
We did.
That level's around 33.75, 34, maybe 35. It's a big zone. Talked about using crayons, not pencils, when we draw on our charts here, when we identify critical levels. Funny how it just dug right in, and it has been catching higher right at that key level. So keeping an eye on that 33 to 35 zone in FCX. Now moving on to rates. I mean, that's a big topic today with the CPI print coming out.
We didn't even mention CPI off the top, but that, of course, is the story of the day and will color a lot of trading action in these markets, because we know, especially the fixed income markets, very sensitive to economic data. So what's happening today?
Well, rates really aren't making a directional move. The 5-year broke lower earlier in the week, even last week. Now it's kind of pulling back. So no decisive movement on the 5-year, 10 or 30-year yields.
So is this just a thing where it's like wake me when there's some action?
Yeah, I mean, I don't. In terms of bonds, in terms of buying bonds, yes, absolutely. In terms of stocks or risk assets, I think this is a great scenario. Stocks love this scenario. And I don't think it's a terrible scenario for commodities either. I'm actually going to point out later in the show, if rates do roll over, that might not be the best situation. That might not be the best environment for pro-cyclical commodities. Yeah. But turning to the TLT ETF, look at this base. Good looking base. Reminds me a little bit of the cotton base we're going to get to later. If and when TLT takes out that 110 level, next area of potential resistance lies up around 120. Now, I like buying bonds. I think we can start to add bonds back to the portfolio after last year. But I don't expect any major movements here leading up to the next Fed meeting. I think it's going to be more sideways range bound action for rates and bonds across the curve in the coming weeks. Dollar rates and dollar, they're so tightly wound together, especially at this point. Dollar coming back, retesting the shelf of former highs around 102, 103, finding support, logical level for the decline since last September to pause, and it has. Again, like rates, dollar's really not going anywhere. Right, that 101 level for the dollar index DXY is in focus if and when we get a downside resolution below 101. That most likely adds a tailwind for stocks, specifically long duration assets. Think tech, communications, discretionary. On the flip side, the dollar index starts to rally if rates continue to rise. We see DXY above 105. The areas that got hit hardest last year are probably getting hit hard again this year. Let's keep that in mind. And when we look at, beneath the surface, or when we look beyond the 6 components of the dollar index, looking at the G10 currency index inverted, and looking at the US dollar AD line, 29 pairs here, it's not, they're not printing fresh lows. They're not revisiting, I should say, those pivot lows from earlier in the year in January, like the dollar index. So for the dollar index to break down and continue to trend lower, see a sustained downside action in the dollar index, I expect to see similar action from the broader currency market. I expect more currencies, not just the top 6 that are in the dollar index, to start to gain against the US dollar.
So bottom line as it pertains to the dollar is a falling dollar is a tailwind for risk assets, whether it be stocks or risk on commodities like silver, etc. Rising dollar means the opposite.
Yes, basically. And we're going to get into that later today.
Yeah. All right. Let's talk about some of your favorite charts, Ian. I know you have one for cocoa, which you and I have not yet discussed, I believe, on this show, since I've joined you. So what's going on in cocoa land right now?
It's funny. I lose track. I feel like I've been talking about cocoa and sugar constantly for the past month. Okay, so we've talked about sugar. Okay, good.
Yeah. We talked about sugar.
So I love this base. I love this big base in cocoa. But when you see these big, these long-term charts, these long-term basing patterns, these resistance levels or support levels going back, half a decade to a decade, these breakouts tend to be messy, right? There's a lot of price memory around here. And that's exactly what we've witnessed. I was zooming in on the daily chart. Luckily, we got a nice base that launched the completion of this larger pattern. Broke out above 28.30, 28.50, pulled back, retested that level, chopped sideways about a month and a half, and yesterday broke out, resolving higher, and it's following through today, trading, let me check here, about 30.26. So the July contract for cocoa is now trading around 30.26, and that's exactly what we want to see. We want to see the bulls step in and continue to drive prices higher. So I want to see a bullish print in the 14-day RSI. I want to see reading greater than 70. So we have a bearish divergence despite the bullish momentum regime. So I want to see momentum work off that divergence, confirming that bulls are in control and this breakout is finally going to stick. If they do.
Hold on. So question, if an RSI over 70 typically means that an asset is considered overbought.
Correct.
Right. But you want to see that because that would confirm bullish trend to you.
Right. I want to see that on a breakout.
Okay.
Right. I want to see that when bulls have absorbed supply and are driving prices higher. Now, in a range bound market, an overbought reading or reading near 70 could be construed as a sell signal. Somebody who for a trader who likes to trade trading ranges, who likes to fade strength and buy weakness. Here, I'm buying strength. So I want to see that overbought reading, and I want to see it continue to remain overbought. I want to see the momentum, stay above 40. That's what I'm looking for. So right now, bulls driving prices higher. We're seeing that follow through. Let's see if it sticks. Let's see if it sticks in the coming weeks. Next chart. I brought this chart just because it was fun. I shared it with readers yesterday for the currency report. It was funny preparing for the gold rush over the weekend. I was looking at the COT profile, the commercial positioning profile for gold futures, and it just struck me how similar that profile looks to the US dollar index. So I pulled it over, overlaid the two charts, and this is what we get. Very, very similar. And it makes sense. It makes sense. Stronger dollar weighs on gold prices. So stronger dollar, cheaper gold. Commercial hedgers, smart money, take advantage of that. It's almost like gold's on sale and commercial hedgers are in there scooping up these bargain prices. That's what I see when I look at this chart. So not necessarily any, earth-shattering, groundbreaking evidence here, but it's interesting. And it's another chart with the commercial positioning continue to unwind in gold, suggesting that the dollar and rates roll over. Again, we haven't seen it yet, but I mean, it's just a long list of evidence pointing to lower rates, lower yields.
Can you explain the commercial hedging thing to me? Who is that exactly?
They're just the mining companies. They could any company that works in the industry. So that's why I like to think of them as smart money, is they have insight, they have details into the gold and precious metal markets that I don't have. So that's why I really like to pay attention to commercials, especially when it comes to commodities. When it comes to index futures, I prefer to look at speculators and see what they're doing and kind of try to pick up on their sentiment regarding equities.
So rising commercial positioning means what?
It means they're bullish. Okay. It means they're bullish because commercials, for most commodities, commercials are the largest net short seller.
Right, because they're hedging themselves. Right.
Yeah, if you notice, if you look at the zero line, I didn't have the zero line in this chart, but if you look over towards the right of this chart and the gold positioning, commercials very seldom hold a net long position in gold. They're usually short. So to see commercials get long or close to net long tells you, hey, they're scooping up gold because they think prices are cheap.
Got it.
Yeah, exactly.
All right.
And that's why it looks just like the dollar, which I thought was fun. I thought it was fun. Just wanted to share that with everybody today and all the readers yesterday.
All right. What else we got?
We got TLT overlaid with growth versus value. This kind of gets back to the chart that I shared earlier of TLT. Is this base going to break out? We're gonna, our bonds going to break out? Our yields going to roll over? Well, according to growth versus value, growth stocks say yes, absolutely. And growth stocks are doing really well today. I don't know how little indecision when it comes to the treasury markets. I mean, bonds are catching higher, but growth stocks are definitely like the CPI print today. So this is, and again, if you notice this lower pain, I wouldn't say again necessarily, but if you notice the lower pain, the correlation here, the 21-day correlation, usually positive, is beginning to turn negative. Right, we're seeing a divergence between these two charts, a decoupling of this common relationship is normally positive. The question is, who's got it right? TLT or growth stocks? We'll see.
I don't know. I
don't know either. We'll see.
Yeah.
We'll see. We'll see. I got a feeling that growth stocks are right here, but again, we have to wait for an upside resolution for confirmation.
All right, let's move on to our sleeper segment where Ian looks through the doldrums, looks through every nook and cranny of his chart universe and looks for charts that maybe aren't necessarily screaming buys right now, but they're acting in a way that suggests they're maybe flying under the radar. Maybe you want to keep it in the back of your mind for the next couple of days or weeks ahead. And the reason we're both wearing plain white cotton t-shirts today is because Ian talking about cotton.
Cotton, that's right. And you know what's interesting about, you mentioned like, keeping these charts on your radar. They're not necessarily poised to break out in the coming weeks. These are kind of the sleepers, and it's tough. And from a trading perspective, it's tough to keep these charts front and center when they continue to just chop sideways. And that's exactly what cotton's been doing for months now. Testing this critical retracement level around 90, around, let's say 89, pounding this level. I thought we were going to get an upside resolution early this year. We did not. Bears drove prices lower, but it's still continuing to carve out what looks like a tradable low. We zoom in here on the daily chart of July cotton. The level is 88.34. I say 88.50. 88.34 level marks the January 23rd close. Around 88.35. Now, if and when July cotton closes above, so again, 88.50, I like it long with an initial objective up around 106. And that's back up towards the area of highs from late August of last year. That's an initial target. Get above 106, then we can start thinking about getting back up towards 115 and this key retracement level from the recent rise off of the 2020 lows. But yeah, this is a great looking chart. And again, let's bring it back to momentum. Let's bring it back to the 14-day RSI. I don't use a lot of indicators, but I like momentum. It works for me. I understand it. Again, July cotton, it's in a bearish regime, right? Bears are still in control of this market as bulls step in and support or continue to accumulate what looks like an accumulation here of cotton. Now, if and when July cotton's back above our risk level, if and when it takes back that 88.50 level, I expect to see at least, the very least, I expect to see the 14-day RSI above 65. Now, it's not necessarily an overbought reading, but it would be the highest RSI reading in almost a year. That would, for me, that would indicate that we're out of the bearish regime. Once it gets above 70, and that's confirmation that the bulls are in full control. So keep that in mind. Got that on my radar.
All right. So we mentioned earlier, of course, the big news today from the market standpoint was the April CPI print, which came in mostly in line. Actually, the headline number was actually a smidge below the estimate there, but let's talk about CPI for a second here in our breakdown segment, Ian, because we know, of course, that all these markets that you're looking at, whether it's fixed income, whether it's commodities, currencies, they are all highly sensitive to economic data. And right now, there is probably, with the exception of the Federal Reserve, there is, and their rate decisions, there is nothing else that the market watches more closely than CPI. And we only get this rating once a month, so it's very important. So I was hoping we could just talk about that for a second, and how commodities react to rising CPI, falling CPI. We are in a deflationary environment right now, where inflation, obviously it's spiked up and is now cooling off a little bit, which is what the Fed, of course, has wanted and been trying to accomplish. But let's pull up maybe that chart you have of the total commodity index with CPI, and just maybe you can explain to us just how those are related.
So commodities are inflationary assets. They do well as inflation rises, and they tend to suffer or turn lower when inflation cools. And that's exactly what we see in this dual pane chart of the CRB index, upper pane, and the CPI year-over-year percentage change in the lower pane. Now, this doesn't have the updated data from today's release, but you get the idea. I originally put this chart together simply to share with readers that I don't really pay attention to economic data. I prefer to focus on price. You don't go back and revise price. They might go back and revise the CPI in the coming months. I have no idea. I also don't directly trade the CPI data. I trade commodities. I trade currencies. I trade stocks. So I trade price. So that's what I like to focus on. So the point of this chart, at least originally, was simply to show that, you know, we're really following the same thing. We're following the same thing. I just choose to focus on what I consider matters, which is price action. So what's interesting, what I wanted to share, is take it a step further today. We're talking a lot about rates. We've been talking a lot about yields. So as the CPI, we imagine as CPI begins to fall, rates will probably begin to fall as well. Dollar will begin to roll over. Like, yes, you know, that'll finally be that much needed tailwind for risk assets, a weaker dollar. I think it's very important for some risk assets and precious metals, not all risk assets. I want to share that with you today. First off, here we go. There's the dollar and rates. All right, 10-year yield, US dollar index, strong positive correlation. And we've seen this positive correlation has really kicked in since the fall of 2021. That's back when the Fed was trying to figure out actually, you know, what's going on with this whole inflationary environment. Is it transitory? No, it wasn't transitory. It's actually sticky, and we're dealing with that stickiness today. Once they started to hike in the spring of 2022, that correlation just got stronger, and it's remained strong since. So we're still in an environment where the 10-year yield is tightly wound to the US dollar index. So falling inflation, falling yields, falling dollar, at least for now. That, a weaker dollar, look at this. Look at the negative correlation between the weaker dollar and the MSCI All Country World Index. Weaker dollar is definitely a boon for global risk assets. Hands down. We see that here. Dollar's been rolling over, and the ACWI, this All Country World Index, has been catching higher. You can see how strong this 40-week correlation is, negative correlation is down here in the lower pane. This is what we refer to when we say a weaker dollar is good for risk assets. This is the tailwind we're talking about. Right? However, I don't think that applies to commodities. And I don't think it applies to pro-cyclical commodities, such as base and industrial metals and energy, crude oil. It was interesting last year, or even a year and a half ago, almost 2 years ago. Remember in the spaces, you know, throwing around, you know, ideas of, you know, why commodities and the dollar were trending together. They generally have a really strong negative correlation. That correlation has turned positive in the past 2 years. And that had a lot to do with the rising rate environment. When rates started to really pick up, Fed steps in and starts to hike interest rates. And this is what we get. Now, dollar rolls over here. I still think we're in this environment where commodities follow that breakdown. Will that change? Absolutely. As you can see, relationships, correlations come and go. I imagine that that negative correlation between the dollar and the CBR index kicks back in at some point in the future. I just don't think that's in the coming months or quarters.
Correlations come and go, but price stays forever.
That's right. That's right. Yep. Absolutely. I like that.
You're welcome.
To use it. I'm going to use that one. Here's another chart that speaks to gold doing much better or outperforming crude oil as rates roll over. There's crude versus gold. Looks almost identical, tick for tick, over a longer time frame here. with the US 10-year yield. And we're already seeing crude oil underperform gold. Are rates going to catch lower? I think the answer is yes. Again, we have to wait and see. Another performance chart here, or a performance chart I wanted to share with you. This is the performance of the different subgroups, commodity subgroups, since the US dollar peaked back in September of last year.
All right, so precious metals up, livestock up, softs, which is that's like coffee and that stuff, right?
Cocoa, sugar,
that's all up, and energy, the other energy down bad.
Yes, energy-based metals and grains. See, the pro-cyclical commodities not enjoying a weaker dollar. They're not enjoying a weaker dollar, right? Because a weaker dollar means lower rates, right? However, precious metals and then livestock, softs, I think of those. I think even precious metals, you can kind of put precious metals in that defensive kind of group when it comes to commodities. Base metals, energy, more offensive. Precious metal, livestock, and more defensive. So they're definitely the more defensive areas of the commodity space are enjoying the weaker dollar more so than energy and base metals.
And you see no reason why this should change if the environment of a falling dollar continues. There's no reason this should change.
Not in the immediate future, no.
Right. Okay.
No, I don't see any signs that should change. Yeah. And you look at precious metals versus commodities, and this is our precious metals index. Gold, silver, platinum, kick palladium out of there, versus our equal weight 33 individual commodity contracts equally weighted. Precious metals are resolving higher from a bearish to bullish reversal. I'm going to pull that arc a little over there. I'll fix that. This just speaks again to, we're in an environment where we want to focus on precious metals. These are the areas, these are the areas of the commodity space that are most likely going to outperform and continue to outperform if and when that downtrend of the dollar resumes and rates finally roll over.
Got it. And
last but not least, I want to end on this chart for this section, looking at the junior gold miners. Now, remember earlier pointing out XLE and how XLE just recently broke down earlier this year, violated this upward sloping trend line. And on the flip side, those risky junior gold miners are violating a downward sloping trend line. And so we're seeing a rotation out of energy, out of the pro-cyclicals, and into the precious metals, livestock, softs, more defensive areas. That's what's underway right now. And I think that needs to be the focus, even when rates begin to roll over and the dollar breaks down.
All right. As far as upcoming events, we of course had CPI today. PPI, which is the other side of the inflation coin, the producer price index, is tomorrow morning, Thursday, 8:30 a.m. Eastern time. That's really it as far as macro stuff. Mr. Culley, any final words of wisdom for us as we head off into the rest of our Wednesday?
Keep an eye on cotton. Don't lose sight of cotton. I think that base could really go here. I don't know when. I don't have a crystal ball, but I'm going to keep that on my radar. I'm looking for that follow through in cocoa and dollar and rates. It hasn't changed.
All right. If you want Mr. Culley's research sent straight to you, you have to go to allstarcharts.com/join. to sign up for the All-Star Charts premium membership. There should be a link in the description of this video as well. You can always email info@allstarcharts.com. There should be a number on our end screen as well to call if you prefer to talk to a live human being. Follow Ian on Twitter. His Twitter handle should also be in the description @Ian Culley, as well as a link to his most recent blog post. And I think that's it. Did I miss anything? I don't think I did.
I don't think so. Sounds good.
I don't think so. All right, Ian. We'll talk again on Friday for our next show. Everyone, happy trading and smash that like. Have a good one.
See you guys. Thanks for watching.